They said Bitcoin was dead not once, not twice, but at least 5 times. And yet, here we are more than a decade later, and it's still alive. So, was it a bubble or the beginning of a financial revolution? Let's rewind to the start.
In 2008, the global financial system nearly collapsed. Banks were bailed out, people lost their savings, and trust in the system shattered.
Out of that chaos, an anonymous figure named Satoshi Nakamoto published a 9-page document, the Bitcoin White Paper.
It proposed something radical, a new kind of money owned by no one, controlled by everyone. No banks, no middlemen.
Just math, code, and a global network of computers verifying every transaction. For the first time, digital money could exist without a central authority. It was open, transparent, and unstoppable. At first, hardly anyone noticed. In 2010, someone famously bought 2 pizzas for 10,000 bitcoins, worth about $40 back then. Today, those same coins would be worth hundreds of millions. That story became crypto legend, not because of the pizzas, but because it proved one thing: Bitcoin had real-world value. Then came the first wave of believers, miners running computers in their garages, idealists talking about freedom from banks, and skeptics calling it a scam. Bitcoin's price jumped from pennies to dollars, then to hundreds. By 2013, it reached $1,000 and then crushed. The media declared it dead, but every time it fell, it came back stronger. Soon, new ideas started to appear. Ethereum launched not just as a coin, but as a programmable blockchain. It allowed smart contracts, code that could automatically execute agreements. That innovation gave birth to DeFi, decentralized finance, where people could lend, borrow, or trade without traditional banks.
The ecosystem grew fast, and with it came chaos. Scams, rug pulls, lost wallets, and wild speculation turned the space into a digital Wild West. In 2017, Bitcoin hit $20,000 for the first time. Then it crashed again, wiping out billions in weeks.
But by 2020, when the world was in lockdown, interest returned. Institutional investors joined in. Major companies started adding Bitcoin to their balance sheets. Suddenly, what began as an underground project became a global conversation. But here's the paradox: Bitcoin's strength is also its weakness. No one controls it, which means no one can fix it when things go wrong. Its value swings wildly, making it both fascinating and frightening. For some, it's digital gold, a store of value. For others, it's pure speculation. What's certain is this: Bitcoin changed the way we think about money. It made us question banks, inflation, and who truly controls our financial future. It sparked an entire industry, from blockchain innovation to NFTs and decentralized apps. And whether you believe in it or not, you can't ignore it anymore. Bitcoin is no longer just a coin. It's a movement, a symbol of digital rebellion. And like every revolution, it's messy, unpredictable, and unstoppable. So maybe the question isn't whether Bitcoin will survive, but how it will evolve.
Bitcoin may have started as a digital experiment, but today, crypto lives in the real world. It's no longer just for tech geeks or early adopters. From everyday payments to decentralized apps, crypto is reshaping how people use and think about money. Let's start simple. Imagine sending $500 from the US to a friend in another country. Through a traditional bank, it might take 3 to 5 business days and $40 in fees. With crypto, the same transfer can happen in minutes, sometimes for just a few cents. That's not theory. That's what's happening right now through blockchain networks like Lightning or Solana. Millions of people already use crypto wallets instead of bank accounts. In some parts of the world, where access to banks is limited, crypto became a gateway to financial freedom. People can save, trade, and invest, all from a smartphone. It's banking without the bank. But crypto isn't just about Bitcoin anymore. Let's talk about the ecosystem. Stablecoins like USDT or USDC are digital tokens tied to the US dollar. They solve one of crypto's biggest problems: volatility. You can use them to pay freelancers, buy goods online, or transfer money across borders, all without worrying about wild price swings. Then there's DeFi, decentralized finance. Think of it as Wall Street without walls. Through apps like Aave or Uniswap, users can lend, borrow, or earn interest automatically, all powered by smart contracts, not bankers. No waiting for approvals, no hidden fees. Just code, transparency, and control. Of course, not all crypto use cases are financial. NFTs, or non-fungible tokens, turned digital art into a new asset class. Artists can now sell their work directly to collectors, musicians can earn royalties automatically, and gamers can truly own in-game items. Whether you love or hate NFTs, they proved one thing: ownership in the digital world is changing. Companies are joining in too. You can pay for a Tesla with Bitcoin, at least you could for a while, and major payment apps like PayPal, Revolut, and Cash App already let users buy, sell, and hold crypto. Even traditional banks are experimenting with blockchain for faster transactions and record keeping. But let's be honest, the real-world side of crypto isn't all smooth sailing. There are risks, scams, hacks, and massive volatility. DeFi platforms can be exploited. People lose private keys and their funds forever. And not all coins are created equal. Many projects promise innovation but deliver nothing. That's why education and caution matter more than hype. Still, every innovation comes with growing pains. The early internet was full of scams too, and yet it changed everything. Crypto might follow the same path: early chaos, followed by mass adoption and regulation. In fact, governments are already moving. Some countries are developing their own CBDCs, central bank digital currencies, like digital versions of national money. These aren't the same as crypto, but they use similar technology to make transactions faster and cheaper. So while crypto challenges traditional systems, it also inspires them to evolve. Let's look at a real example. If you use Wise or PayPal to send money abroad, you're already benefiting from fintech innovation that borrows ideas from blockchain, faster settlements, transparent fees, and global reach. Crypto just takes that one step further, removing the middleman entirely. At its core, the message is simple: crypto is no longer a fantasy. It's a tool, powerful, risky, but full of opportunity. It's not about getting rich overnight. It's about building a system that works faster, cheaper, and for more people than ever before. The future isn't about cash or crypto. It's about choice.
Crypto offers freedom, but with freedom comes risk. Understanding those risks is what separates a smart investor from a lucky gambler. Let's start with the biggest one: volatility. Prices in crypto can move up or down by 10, even 20% in a single day. That's not just theory. We've seen Bitcoin crash from $60,000 to below $20,000 in less than a year. For someone investing short-term, that can be devastating. But for long-term investors who understand the cycles, volatility is part of the game. The next risk is regulation. Governments around the world are still figuring out how to handle crypto. Some embrace it, like El Salvador making Bitcoin legal tender. Others restrict or ban it, worrying about money laundering or financial instability. The truth is, the future of crypto will depend not only on technology, but on how laws evolve to balance innovation and protection. Then there's security. Every few months, we hear about another exchange hack or phishing scam. People lose millions because they clicked the wrong link or trusted the wrong platform. Unlike banks, crypto transactions are irreversible. Once it's gone, it's gone.
That's why experienced users say, not your keys, not your coins. Meaning, if you don't control your wallet, you don't really own your money.
Another challenge is scams and hype. New tokens appear every week, promising 1,000% returns and revolutionary technology. But many are pump and dump schemes. They rise fast, crash even faster, and leave investors broke. In crypto, skepticism is your best friend. If something sounds too good to be true, it usually is.
Still, despite all the chaos, something powerful is happening behind the scenes. Every year, the technology gets stronger, safer, and more integrated with the global financial system.
We're seeing serious players, banks, funds, even governments, exploring blockchain for faster settlements and transparency. Let's look at DeFi 2.0, newer platforms focusing on security and real-world use cases. They're working on insured lending, decentralized identity, and tokenized assets like real estate or art. Imagine being able to buy a fraction of an apartment or invest in a startup instantly from anywhere. That's not science fiction anymore. It's being built right now. And while Bitcoin dominates the headlines, there's a much bigger story here: the digitization of money itself. From stablecoins to central bank digital currencies, the line between traditional finance and crypto is starting to blur. In the future, you might hold both digital dollars and Bitcoin in the same app, spending one, saving the other. So, is crypto a bubble? Maybe, but so were railroads, .coms, and smartphones at first.
Every major innovation starts with hype, crashes, and then rebuilds stronger. Crypto is walking that same path.
Here's what matters most. You don't need to believe in every coin or every project. You just need to understand the movement, the idea that technology can make money more open, transparent, and accessible to everyone. If you choose to explore crypto, do it with caution and education. Diversify, start small, and never invest more than you can afford to lose. But also, don't ignore it completely, because whether you like it or not, the world of money is changing. And one day, when you tap your phone to pay, invest, or send money across the globe, it might not be a bank behind it. It might be a blockchain.